Experts say just buy ETFs and relax. Set it and forget it. But here's what they don't tell you. 7 quiet mistakes are draining real money from real portfolios right now. We're talking over $100,000 in lost wealth on a $50,000 investment, not from bad luck, from fixable errors, and most investors have no idea they're making them. Let's fix that. Every number in this video comes from real data. ETF.com, Yahoo Finance, Portfolio Visualizer, and Morningstar. We ran 10 popular ETFs through 8 key metrics each. Tax cost ratios, drawdown, behavioral gaps, overlap scores. This isn't opinion. It's a forensic breakdown of where investor wealth actually disappears. The findings were honestly surprising, even for us. Here's what the data revealed. Before we get into the mistakes, understand the world these ETFs are operating in right now. Rates near 5% have changed everything. The 10-year Treasury sits around 4.2% in 2026. That matters because it changes which ETFs hurt you most. Bonds, covered calls, leverage funds all behave differently in this environment. And mistake number 1 exploits exactly that shift. When the 10-year Treasury yields 4.2%, every percentage point you lose to tax drag is enormous. That's real money competing with a risk-free return. Tax drag ranges from 0.3% on VOO to 1.5% on active bond ETFs. That gap sounds small, but compounded over 20 years on $50,000, it quietly becomes something devastating. The next slide shows the exact number. Tax drag. Most investors have never heard of it. It's the return you lose every year just from taxes triggered inside your ETF. VOO loses just 0.3% annually, but VNQ loses 1.1%. HD-style active bond funds lose 1.5%. On $50,000, that's up to $750 disappearing every single year. And that's before compounding destroys you further. $18,000. That's what tax drag alone costs on $50,000 held over 20 years in a taxable account. In the wrong ETF. Not a market crash. Not a bad pick. Just holding VNQ or QYLD outside a tax-sheltered account. The fix is simple, but almost nobody does it. Account placement is the most underrated decision in ETF investing, and slide 7 shows exactly where each fund belongs. Look at this clearly. VNQ earns 8.5% before tax, but only 7.4% after. That missing 1.1% belongs in an IRA or Roth. QYLD and JEPI belong in a Roth IRA. Meanwhile, VOO loses just 0.3% to tax drag. Perfectly fine in a taxable account. The right fund in the wrong account is still the wrong decision. Now, mistake 2 is even sneakier. Here's the illusion. You own VOO and BTI. Feels diversified, right? 2 different ETFs, 2 different ETFs, 2 different names. But 82 cents of every dollar you invested is in the exact same stocks. That's the overlap trap. You're not spreading risk, you're doubling down on identical positions while paying 2 expense ratios. And VOO versus QQQ, still 46% overlap. You think you're diversified. The data says otherwise, 82%. That's the VOO and BTI overlap. Apple, Microsoft, Nvidia, they dominate both funds at nearly identical weights. Owning both is like buying the same portfolio twice, and it costs you. 2 expense ratios on essentially the same exposure waste $200 to $400 on $50,000 over 20 years. Wasted money on 0 additional diversification. But the next mistake doesn't just waste money, it destroys it. TQQQ promises 3 times the return of QQQ. Sounds powerful. But there's a mathematical trap built into every leveraged ETF. It's called volatility decay. When markets bounce up and down, the math compounds against you, even when the direction is eventually up. $10,000 in TQQQ doesn't become 3 times what QQQ returns. It becomes less, sometimes dramatically less. The next slide proves it with real numbers, 77%. That's how far TQQQ fell in 2022. QQQ dropped 33% that same year. 3 times the leverage didn't mean 3 times the loss. It meant more than twice as bad. And here's the brutal math. After a 77% drop, you need a 335% gain just to break even. Most investors panic and sell long before that recovery ever arrives. This is the slide that changes everything. Over 3 years, TQQQ returned negative 4.2% annually. QQQ returned positive 8.9%. 3 times leverage should have delivered positive 26.7%. Instead, negative. The Sharpe ratio on TQQQ is 0.41 versus 0.82 for QQQ. Less return, more risk. more volatility. Decay is embedded in the math itself. 11.8% yield. That's what QYLD advertises. It sounds incredible, but here's what that number hides. QYLD's 5-year total return is just 3.1% annually. D-income payments are real, but the fund's price erodes to pay them. Meanwhile, SCHD yields 3.5% and delivers 10.2% total return. VOO yields 1.3% and returns 13.1%. High yield, low wealth, $47,000. That's the wealth gap between a QYLD investor and a VOO investor on $50,000 over 10 years. The QYLD investor collected income checks, felt great every month, but the asset base quietly shrank. VOO compounded silently and won by $47,000 before taxes on those distributions. Choosing QYLD for income is like selling your furniture to pay rent. You get cash. You lose the asset. Mistake 5 feels logical. Own international stocks through VXUS. Add bonds through BNCSDA. Classic diversification, right? But look at what actually happened during the 2020 COVID crash. VXUS moved almost identically to the S&P 500. And BND? In 2022, it dropped 13.1% alongside stocks. The diversification you thought you had vanished exactly when you needed it most. VXUS has a beta of 0.87 and a correlation of 0.94 to the S&P 500 during the COVID crash. That's not diversification. That's almost the same fun with extra steps. On a $50,000 portfolio and a 30% market drop, VXUS fell roughly 26%. That's an estimated $8,000 in additional loss beyond what true diversification should have allowed. And get this, you check the expense ratio, QYLD shows 0.6%, looks reasonable, but that's not your real cost. Add the bid-ask spread, add the tax cost ratio of 1%, total cost of ownership on QYLD, 1.62% annually. On $50,000, that's $810 every single year. VOO's total cost? 0.34%. The fee you see is never the fee you pay, $20,500. That's the cost difference between holding QYLD and VOO on $50,000 over 20 years. From fees alone, not performance, not tax drag, just the total cost of ownership gap. QYLD charges 1.62% all in. VOO charges 0.34%. That 1.28% difference compounds into over $20,000 of lost wealth. The last mistake isn't in the ETF. It's in the investor. The behavioral return gap is the difference between what an ETF earns and what its investors actually earn. TQQQ, investors chased it at peaks and sold at lows. The fund's 3-year return was negative 4.2%, but the average investor's dollar-weighted return was even worse. Add it all up. Tax drag, $18,000. Yield trap, $47,000. Hidden fees, $20,500. False diversification, $8,000. Behavioral gap on TQQQ alone, $62,000. These mistakes stack, they compound. On one $50,000 portfolio, the combined damage exceeds $100,000 over 20 years. Every single mistake on this list is fixable, but first, see exactly which ETFs triggered each one. The data is clear. TQQQ delivered negative 4.2% over 3 years, while QQQ returned positive 8.9%. QYLD's 11.8% yield matched a 5-year total return of just 3.1%. VNQ and a taxable account cost $18,000 versus a Roth IRA. $100,000 in combined wealth destruction from a $50,000 portfolio. The master overview is next. Every ETF, here's the full picture. VOO and VTI sit at 0.03% expense ratios with max drawdowns around 24%. QQ trends 18.3% over 5 years, but with a 33% max drawdown. TQQ's Sharpe ratio of 0.41 is half of QQ's. SCHD delivers 10.2% with the lowest tax drag among income funds. 7 mistakes, $100,000, all of it preventable. Start with 3 steps. Audit your overlap. Check your account placement. Measure total return, not yield. The difference between a good ETF portfolio and a great one isn't luck. It's knowing exactly what your funds are actually costing you. Found this useful? Subscribe below. Every week we break down exactly what is happening in the market so you can invest smarter.